Well, here we are, another Friday in March of 2023, and another major bank in the news. A couple of devastating articles today. Zero Hedge talking about Deutsche Bank, and Danielle DiMartino Booth just had a wonderful, wonderful article full of content telling us what's happening in the marketplace. Kind of confirms what we've been thinking about too. Always nice to get a couple extra uh, thoughts on this, but let's make sure there's nothing to see here. No worries whatsoever. Move along. Everything is just fine. But is it? So let's take a look at what's going on. Let me go to my very first slide and let's just talk about it because I think we have a credit event coming. You know, and a credit event is really a problem across the globe. We've been talking about the fact that there's no liquidity. I mean, this has been something we've been talking about for a really long time, and it's gotten worse, hasn't got better. I mean, I know the Fed put up $300 billion this week, but where did it go? They really needed it across the globe. So let's just get into this. So we have a credit event coming. It's this is unfolding very similar to a Lehman and a Bear Stearns, if you can remember, because, you know, when you get to be my age, you remember these things. It was very interesting. So a lot of these events start slowly and then they go all at once. And you're starting to see that the speed is picking up on here. So we've talked about the fact that there is a global liquidity problem. Now, that's not to say that you don't have assets. It's that you don't have any cash. I talk about the fact that you could be a farmer, have beautiful land that's free and clear. You can have 10,000 acres of corn, 10,000 acres of wheat. They're growing beautiful. The weather has been absolutely terrific. But you don't have any cash, and you need to pay your fuel bill, you need to pay your electric bill, and you need to feed the family. That's called a liquidity shortage. And if you can't get cash, what do? You have to start selling something. You know, a lot of these banks are selling, they've got bonds that they shouldn't have bought. You know, Dr. Nenner and I talked about that over 2 years ago. I talked about it last March, and we talked about the fact that get out of bonds. We've been talking about get out of bonds. So here these banks all across Europe have trillions of dollars in sub-zero bonds, and now interest rates have risen and they've lost tremendous losses. You know, so if you have a long-term duration on this and interest rates go up 4 or 5% on a zero, I mean, that's devastating to your bond portfolio. You know, I'm hearing some crazy numbers like the United Kingdom's pension funds lost like 70 to 77% of their value. Now, that's not to say they don't have some assets in there, but they're no longer worth what they were when they bought them. I mean, would you want a zero, interest bond? How about a below zero interest bond? That'd be just a terrible thing to have. So globally, we have a tremendous shortage. Now, this is going back to 2 or 3, 4 months ago. This might even be late October. It's gotten worse. This is a historic. We had a historic bubble. Guess what happens when you put $10 trillion of liquidity into the economy? You get this bubble. And so they call it the everything asset bubble. And of course it is. It went up, it peaked March of 2022, and it's come straight down ever since. We actually have a shortage of cash supply. It's never, ever happened before. And you know how long ever is? Ever is a really, really long time. Let's go to my next slide. So it's just confirming it. This is going into the nominal GDP. Do you see this? Doesn't this look very familiar with we just saw it, that liquidity? Liquidity is the fuel. So look at this blue line. It's following up the liquidity. It's following it down. So this is just a little bit of a leading indicator. You can pretty much be sure that the M2 growth, which is equates into the GDP, is going to follow this trajectory down. And again, this is a little older. It's going to be coming in. And of course, we think that it's going to be very, very evident in the second quarter of 2023. I've talked about that since early last year, that it's going to take a while to percolate, but it's coming. It is on our footsteps right now. It's right at the doorstep. This is something that we are going to experience. It's coming. So when you have this is giving you some forewarning, but it is here now. Let me go to my next slide. And this just goes into the cash. Look at this. This is talking about the banks. So the banks don't have any cash. This is coming right out of the Federal Reserve electronic data system. And it actually have gone negative. So a lot of people are on credit. They borrowed money. They don't have any cash. Literally, the U.S. banks don't have any liquidity. They don't have any money. That's not to say that they're insolvent. They just don't have liquidity. So what happened with the Silicon Valley Bank? They had people withdrawing money and they didn't have any liquidity. So they had to sell these assets that were really the wrong time to sell them. They had long duration bonds. And when we went to sell them, they had to take losses to get the cash. And of course, you just keep selling and selling and selling. Pretty soon now you are insolvent. And that's what's happening. So we have over and over and over from different research telling the same thing, that there's no cash liquidity in the system. Let me go to my next slide. We can talk about that. Now, also here, now I got this from Danielle DiMartino Booth. This was a great article. If you get a chance, I would certainly read that article. It's just absolutely outstanding article. She did great research on it. They're talking about other deposits across the bank. This is just confirming what we already are looking at, is that the deposits are going away. So this is the fuel for the economy. So when that fuel gets taken out of the economy is going to stall. And you're starting to see it all across the globe. Now, Europe is in worse shape than we are. So I want you to understand that Europe really is in trouble. And they've got all these trillions of dollars of negative yielding bonds. Now, the states and the governments force the banks and the pension funds to buy these stupid bonds. They're below zero. Would you buy a negative yielding bond, or would you stay in cash? But they were forced to have 80% of their portfolio in these negative yielding bonds. And then, of course, what happens when interest rates go up? It just decimates the bond portfolio. So they go from having 100% equity to having like 30 or 40%. This is a terrible thing. And of course, if it's a pension fund, now you got 5% burn each and every year, which is growing because baby boomers my age, they're no longer inputting in, they're outputting. So we want to take the money out of these pension funds instead of putting it in. And of course, there's a burn rate. So this is a very, very bad situation, and it's pervasive across really Europe. Very pervasive in Canada and in Europe and New Zealand. They force these companies to have these terrible, terrible bonds. So that's part of the risk adjustment. So shame on you. You should have done that. I wouldn't have done that at all. So you can see that there is no let up on this either. So let me go to my next slide and let's just talk about what's going on. Now, I used this slide, 2 or 3 weeks ago. And here's the interesting thing is that the Swiss National Bank is backstopping the Credit Suisse collapse. So they're the ones putting up $100 billion to backstop Credit Suisse and UBS to buy this. So the Swiss National Bank said, oh, no, we're going to help you. But look what they did just 3 weeks ago. They had to go to the Federal Reserve and get money because they were broke. They didn't have any liquidity. So these guys that are broke are the ones that are backstopping UBS for the Credit Suisse collapse. This is just ridiculous, if you ask me. I just think here's a recipe for problems. Let me go to my next slide. So look at, what happens to this. When you start losing liquidity, that everybody is going to go and start raising their underwriting. Now, this is what happened during the recession of 2022, really short recession in 2020 when we had the COVID recession. Everything got better. And then here we are again. As soon as the banks think it's starting to rain, they take away the umbrella. You've heard that before. So the bank's number one client, the bank. They're more concerned about the bank than you and me, for sure. You just have to understand that they're not fiduciaries whatsoever. So as soon as they have a problem, they're going to take that money away from you. So if you have a credit line that's open and you think you may need it, I would go take that money, because if things get bad, you know what happens? They shut down your credit line. So you think, oh man, I've got a $50,000 backstop for myself. And all of a sudden you don't. Now you're in real trouble. So if you need to do it, take it. Don't go spending it. Don't go buy a new car with it or something. But what we're seeing is the fact that underwriting is getting tougher. So you have to know that commercial and industrial loans are going to be very, very difficult. If you're a builder, you're probably seeing your credit line starting to tighten up on you. That your lenders aren't going to want you to start doing any more development. If you're in an office building with vacancies, you're really, really in trouble. So I would say it's time to be a little conservative on what we're doing. I think we're going to have a phenomenal, just an absolutely phenomenal buying opportunity coming to us. I think we're just going to be able to just buy stuff that we didn't think we'd ever be able to get again. It's coming. It's not going to be very, very long either. So just pay attention with us. You're always welcome to consult with us as well. We do a lot of research. We talk to Dr. Nenner a lot. And we do our own research in the real estate industry. It's been very, very good. We expect it to continue. Here in Phoenix, Arizona, we are in a decades-long real estate bull market, but we're experiencing a correction in that bull market, and it could be a severe correction. If it's a severe correction, we want to just buy everything we can get our hands on. So please stay tuned with us. Also, if you like the content that we deliver, we really try to bring very current and good content, good advice. Please give us a thumbs up. Please subscribe. The algorithms at YouTube, once you get over 1,000, it really helps us with our marketing, and we get a greater reach. We're getting very close to having 1,000. So if you like it, please subscribe. We're not going to sell your name to anybody, but we certainly would like your support. So where was I? Let me get to the next slide here, and let's just take a look at what we're talking about here. Now, if you watch Danielle DiMartino Booth's video and some of the podcasts she's doing and read her research, these are 10 banks that are at risk, and of course, that doesn't necessarily mean that they're going to go down or that they're in jeopardy, but they certainly would have red flags to them. So you need to just pay attention to it. You need to protect yourselves. We have been talking about the fact that most banks, I think the banking system probably is going to resolve itself here for a very short period of time. I don't see the Federal Reserve reversing. There's no pivot coming from the Federal Reserve. They're not going to pivot. They're going to continue. They have a mission, and they're going to stamp out inflation. And it's just, if we don't stamp it out now, look at all the pain we've gone through. There's no sense of stopping now. So it's going to be painful, but it's going to end. So we only have and here's the cool thing is they're already a third through. You didn't even know that. So we're already a third through this downturn. And so we only have another 2/3. So you're almost halfway through. So we're going to do this, figure another 12 to 24 months, and things will be much, much better. At least I think so, unless we have a Mad Max event or something. So it should be better. So we've got a buying opportunity probably coming, maybe even as little as this year. Also, let me mention this as we speak. If you have a real estate portfolio and you're saying, "Oh my goodness, I'm really concerned about my real estate portfolio and I don't want to buy anymore," well, we can do a cross asset hedge. It's called an integrated asset approach, and we can get some hedges on financials. So you can short or put puts on Lennar, you can put puts on or short Toll Brothers. You can short the housing index, and of course, as the real estate prices drop, you're going to start gaining on these shorts. So they should give you a very, very nice hedge. But what happens when you own real estate? So if just the value goes down, you still collect the rents. We get the rents. You get a very, very nice tax savings. If you have any kind of encumbrance on the property, you still get the principal reduction on this. So lots of good things happening on this. And if we can hedge your portfolio, it's fine. I'm not selling anything. I'm just fine with this. Particularly if your places are free and clear, I think rentals are going to be extremely good. We're going to do another video, but I'm hearing things that we're 4 to 6.5 million housing units short. And it was 4.5, but we're kind of like chasing a boulder running downhill. We just can't seem to get enough construction going. Of course, this is going to slow construction. So everyone needs a place to live. So although the values of properties may be going down, probably going to be great places to own. And, I've gone through a couple of these. What happens is rents go down, but it's kind of a statistical going down because there's a migration. People migrate from an A property, which is a high rent, high gloss, lots of new shiny things in it. And then it'll go down to a B property, and people from B property go to C property. So it shows that they're paying less rent. But yes, they're paying less rent, but the rents aren't necessarily going down It's the people are moving to a lower and lower standard so that they don't have to pay as much rent. That happens all the time when we start heading into economic slowdowns. And of course, this could be a severe recession. So having real estate, having that income coming in may very, very well be one of the best things you can possibly have, but it'll be a scary ride. So we do want to make sure we understand what we're doing. And if you're really concerned about that, we can do a hedge. And, these options, you can get a really out of the money option. And if it drops, well, you'll get paid off very handsomely, and they're fairly inexpensive. So we can just work with your financial advisor, your stockbroker, and get that done. So let me get back to my next slide, and let's move to that. So here's this is current. I just got this from Zero Hedge today. It's just stunning. So you need to just take a look at this. So someone along the way has taken $60 billion in repo agreement today. Now the Fed opened up $60 billion. Someone came and took it all. So, and this is a repo agreement between banks, and the Federal Reserve Bank gave the money to. No one is absolutely certain where it's going, but we have a pretty good idea because this is what's going on in the Deutsche Bank earlier today. So in the last March 17th through the 23rd, Deutsche Bank has dropped pretty significantly. Now, most of the banks are doing this as well. So it's not just Deutsche Bank that's being singled out here. But we are seeing the fact that we've had a pretty significant drop in the value of their property. But look at here. So the credit default swaps for Deutsche Bank are soaring. Now, this is what happened with Credit Suisse just last week on a Friday. Today's Friday again. Credit default swaps are just going like crazy. And of course, the credit default swap is kind of like an insurance policy, and they're going right through the roof. I don't think they've ever been this high, and that is certainly concerning. And then look at this. So we're getting the Tier 1A bonds are collapsing. So this is happening right now, and the yields are up over 16%. So we've got credit default swaps soaring. We've got their T1 bonds. And keep in mind, Credit Suisse last week, they wiped out the bondholders. The equity holders got a little something, and they wiped out the bondholders. So if you're a Tier 1 bondholder, you might be thinking, well, maybe I'll take less on my bond today, so I make sure I get something, because they're just collapsing. So this is not a good thing. So let's just reiterate: we know that we've got very little liquidity through the system. We've got rates going up throughout the world, so it's not just the Federal Reserve that's going up. The Federal Reserve just raised rates this week. I see no let up on them. I don't think they're going to pivot. I think they're going to go 6.5% pretty readily. This is going to impact the dollar. There's losing some confidence in the dollar, so we need to be getting into real assets. So if I have advised my clients to have 3 or 4 months worth of cash at home, just in case you can't get to the bank or the bank's closed when you get there, you want to have some cash on hand. I don't think there's anything wrong with having some food and water in the house and additional medicine for yourself, just in case we have some little turmoil in the marketplace. I would think that this is just very good business to do this. I would certainly have some liquidity. If you have a line of credit, you may want to draw that line of credit and put it somewhere safe. Take that money and put it somewhere safe. I wouldn't spend it. This is again, it's a lifeline for you. So I would go ahead and take that. And even if you have to pay some interest on some credit line that you're not using, probably worth doing something like that. So I'm here you're welcome to reach me at michaeldouville0@gmail.com. You're always welcome to make some comments. I'd love to see your comments. Love to make sure that people, I'd love to get your thoughts. So please give me some comments. Please subscribe. And this is my very best to you guys. My best. Bye-bye now, guys.